Morning, everyone, and thank you very much for being here this morning to listen to me talking about H&G High Conviction and the raise that we just launched today. So we're looking to raise up to $3 million, and this has been brought about by some inbound demand from new and existing shareholders. So for those who don't know much about H&G High Conviction, I'll just give a very brief overview of who we are and why we're out here today doing this raise. So we invest in microcap companies. We are a publicly listed company. We look to invest in sub $300 million market cap companies. Our sweet spot is around the $100 million sub mark, and we like to really get involved with the companies that we invest in. We have a concentrated portfolio of about 15 to 20 companies at any time. And our goal is to be the experts in those companies, invest in ones that most institutions aren't looking at, and be there for the long term, support management for 5 or 10 years. We are very excited about this current time because we're seeing compelling value in the current market with some of the highest potential returns we've seen for a long time. And that's just by virtue of share prices falling, people and institutions leaving the microcap space, and so it's really created this vacuum, which for us is great. So we're seeing some very good margin of safety where we get to invest in companies at very low multiples and high asset backing. We're not really trying to just build funds under management for the sake of it. We intentionally like to stay small and nimble, and that is so we can invest in these smaller companies and not end up with really large chunks of them. So we're targeting probably the upper echelons of $100 million in FUM, and we'll return capital as we get there and through dividends and even buybacks. One other thing I want to mention is that there's 100% alignment in what we do. So Hancock & Gore is the investment manager of H&G High Conviction. It owns shares in the fund. My family owns more than 25%. So we are very much focused on shareholder returns. We're doing this raise at $1.04, which is the NTA that we released today. And again, it's because we really want to look after shareholders. We don't want to dilute and just keep on doing dilutive raises, but it's very much about long-term shareholder value. And to that end, we have a very tight register where more than 75% is owned by by the top 20. As I say, my family's more than 25%. Perennial value is around 14%. Unit holders who were in this vehicle since 2007 are about 30%, and H&G is 7%. And we have a long-term track record of strong performance. So this is the important information here, and this presentation is up on the ASX, so you can have a look through it any time. So I just want to start off by talking about the compelling opportunities we're seeing today. So I think we all know that microcaps have dramatically underperformed, and there's been this rush to liquidity, really, and people not wanting to have anything to do with smaller companies. So what we've done here is just plotted the last 12-month return of the ASX Emerging Companies Index, of which the median market cap is about 250 mil, against the ASX 200 index, which we know is above $10 billion for the median market cap. And you can see that there's an almost 20% underperformance from these smaller companies. And you can see, historically speaking, it's a pretty good time to start buying when you have this bigger discrepancy. So we are very excited. We think that people have just sold off these small companies without thinking much about the underlying value of these businesses. And again, we're very happy to be raising this money and putting it to work at this time. Second thing along those lines that I'd like to share is we're seeing a striking number of investment opportunities and those that pass our screens into our sweet spot. So on the most basic level, we've just shown since over the last 20 years, since 2004, all the companies that pass through the simple screen of less than $200 million market capitalization and revenue greater than $5 million per annum. And you can see that it's been pretty steady at certain times, but over the last few years, we've seen a really marked increase. We now have 500 companies that pass those metrics. And it's a mix between the plethora of IPOs that we saw took place in 2021 in the smaller space, but then the subsequent sell-off. So you've had a lot of companies that were valued above 200, which have come back down into our spot So again, we're very excited. We're seeing a lot of inbound deals from brokers and from companies who might have done a raise a few years ago thinking that they could keep on raising at high values. They've avoided doing them for the last year or so, but now they've run out of cash, they need it, they need to recapitalize, get rid of some debt. So this is a fantastic opportunity again for us to be deploying into this microcap space. So I mentioned that we have been going for a long time. We have a long-term track record of outperformance of the market. We started life in November 2007, which again was very interesting times to be investing, and haven't really looked back. And we've had this ability to be able to invest in these companies that just people aren't looking at. And it's meant that our returns have generally been pretty uncorrelated to the market. And again, we're just very focused on companies with high levels of assets or cash flow and low levels of debt, and where we can really become the experts in those companies. In terms of why we brought this product to market and where we really feel we fit and our niche part within the investment landscape. So we believe we're really the only true microcap listed investment company. So that means we're investing in companies that really are sub 300 mil, and our median market cap is actually 46 million. So we're really in the space that is niche, and that's how we get some fantastic opportunities, because the impetus for a lot of investment companies and funds is to just grow to be as big as possible, to get big management fees. We deliberately stay small so we can be nimble and invest in these, and we're also very concentrated. We're not afraid to be, as our name says, high conviction on companies, hold them for many years, and our average is at the moment about 6 years for all of our holdings that we've held them for. So we really get to know them well. We often one of the few institutions on the register and stick with them. And of course, we've had a good last year, as this shows. Of course, not every year is going to be the same, but the strategy has been bearing fruit for us. I just want to talk about how we view our holdings and conceptualize the whole life cycle from beginning investment to the end, because a common question is, how do you deal with liquidity, and when do you exit? So we find these companies that again have been overlooked. The market's just not particularly interested in them, and we see that there's this inherent value. The next thing we have to see is that there's a pathway to realizing the inherent value, because you can have value traps all the time. You can have companies trading at half of their asset backing, but how is that value going to be unlocked? So we have to see that there's 2 or 3 or 4 steps that can be taken either by us, by being actively involved, or by other shareholders or the board to unlock that value. So that's the beginning part. And then, of course, we have a target price for these companies, and we wait until they reach that, and that can change over time. But if they do reach that, then we naturally sell and move on to the next one. So I bring your attention here to a few of them. So starting at the top is PropTech Group. That was a company that we invested in, and one of our shorter investments. It was in July of last year. As part of the whole tech sell-off that has been going on, people just not wanting to be involved in any tech company, let alone a microcap one. This had the lion's share of the market for customer relationship management within the real estate industry. So we invested in that, and we had a target price, and it got taken out by private equity, as we're seeing is happening for a lot of these small microcaps. And that was in February of this year, the deal went through. So it reached our target price pretty early on. One of the more recent investments we really made a proper investment, a substantial investment in about 2 months ago, is Connection Telematics. That's CXZ is the ticker. Really interesting company that is mandated by General Motors in the US to be the fleet management software provider for all its dealerships, all affiliated dealerships in the US. So it's got an amazing real recurring revenue, and it just got completely pummeled by the semiconductor chip shortage. So there were less cars in use in these dealers for fleet management, and it had also been quite poorly managed in the past. So there are reasons why its price is very depressed, but we were buying it and still own it on what we believe to be a few times its EBIT, and that is quite remarkable for a software company. And we also believe it's very well managed by someone who knows how to allocate capital and is very focused on that. So it's a unique opportunity, we believe. It's buying back stock, and so we're quite aligned to its journey. So that's a more recent investment that we're excited to be on for the longer term. And another two that I'll just point out that have been very long-term holdings. One of them is Po Valley Energy that you can see. So that is owns natural gas fields in Italy. We first invested in this 14 years ago, so pretty early on in the fund's inception. And again, it just shows we really do hold on, and we believe that this company had valuable assets, strategic assets, natural gas fields in Italy, a country that imports 90% of its gas, which accounts for most of its energy and electricity production. So we thought that owning domestic assets would be very, very important. So we invested and held this. I joined the board of that about 18 months ago to help really get shareholder focus and shareholder returns. And part of that process has borne fruit, along with some macro tailwinds, and has produced a good 200% odd return over the last 2 years. And we believe there's still further to go, but as you can see, we've held it for 14 years and it's further along its journey than someone like a Connection. One other very brief one I'll mention is Kyland. The ticker there is KIL, and that owns about over 15,000 hectares of land on Kangaroo Island in South Australia. It's currently developing that land and turning it into timberland into agricultural land, most likely to be used for sheep farming. And in the process of doing this, and it owns all this land unencumbered by debt, it has to do something with all these partially burnt trees that were conflagrated in the bushfires of 2019 to 20. It's going to turn all that timber into biochar and become one of the biggest biochar projects in the world, which of course can generate carbon credits. So it's a very interesting company where you have this base asset, and that's just all this land, which is very high rainfall, but also this asymmetric potential return from the carbon credits business. So of course, the most important thing for any company, and ours is no exception, is the people. And I'm very fortunate to have working around me an amazingly talented and experienced group of people. So I'll just start across the top, and our chairman, HCF's chairman, is David Groves, who's had many years of experience working for on boards, and he was on GrainCorp's board. He's on Pengana's and EQT's, so he really knows how businesses work, and that's crucially important for us because we are investing in real businesses and holding them and getting involved in joining boards. So that brings a lot of benefit to us. Sandy Beard is the chairman of Hancock and Gore, our investment manager, and he's also a shareholder in HCF. He's also been on dozens of ASX listed boards, a lot of microcaps. So he really, again, just knows how the board table works, how to create value for shareholders, and is a fantastic just sniff test when it comes to all the people involved in the wider microcap industry. We have Nick Atkinson, who is ex-Morgan's head of institutional equities, and he's the director of HCF and also involved in H&G. Phil Christopher, who's in the H&G side and is in the private equity business, ex-Goldman Sachs and Alcyon, and brings a fantastic perspective on the private equity world. And that's very crucial for us because the way we invest in microcaps is we think of them as quasi-private businesses that we can buy at very cheap values because their shares are listed. And then finally, we have Arthur Foxshana, who's works on the day-to-day HCF portfolio and is got an amazingly deep analytical mind, and he's the brains behind all the understanding of where we are at the moment in all these industries and where we're going into the future, and can just get into that deep analysis. So I mentioned the raise we're doing. We're looking to raise up to $3 million. I also mentioned that that's really been prompted by inbound interest. And we think this is a fantastic time to be doing it because of all the opportunities. The offer price is $1.04, which is the NTA that we released today. and Morgan's is the lead broker. So if anyone's interested, they can contact me, they can contact Phil Lee from Morgan's or Nick Atkinson from H&G. And it's important to mention that all the costs of the offer and the raise are being borne by the investment manager, Hancock and Gore. And that's, again, just a policy to continue focusing on shareholder returns for HCF and not be diluting shareholders along the way as we build some scale over time. So I just want to cap it off in why invest now in HCF. So this placement is a way of getting set. So I mentioned we have a very supportive shareholder base, and there's not much stock around to buy at any given time. In fact, I think at the moment there's no offers in the market. So if you want to get set, you have to buy through a placement like this. I mentioned this is a true buyer's market that we're entering. We're in and continuing probably for a bit of time, where we're in a very good position to be dictating terms for recapitalizations or buying very, very depressed share prices in companies. We believe that this will help continue giving us the scale to have a voice around the board table and in these companies for increasing shareholder focus amongst companies and increasing accuracy and thought about allocating capital, and not maybe that we've seen when money was very easy to come by in recent years for companies to just keep on doing very dilutive raises. But we are excited to continue being that shareholder presence. I mentioned there's very strong alignment between HCF in the manager and its shareholders, and my family owns 26%. We intend to continue paying dividends, and we'll frank them to the maximum extent possible. We paid our first 2-cent dividend in the half. And I really think that HCF is a complementary strategy for most investors. It's probably not going to be the only thing that you invest in and your only exposure to the equity market. And you might, be keen to continue that allocation to the very, blue chip side of things. But we really think that in volatile markets, as we see now, and there have been some pretty poor index returns, we can provide some outperformance and some uncorrelated returns in the equity market as these fantastic opportunities present themselves. So on that, I want to thank you for your time and welcome any questions. So you can either put them through the chat box on Zoom, or you can also email them to me if you want to just keep them private. Joseph@hng.com.au. You can see my email down the bottom. And I really am open anytime for questions and discussions about stocks, about HCF. So feel free to call or email, whether it's in the next couple of days for this raise or in the future. But yeah, very much appreciate you listening in, and would love to see you all as shareholders of HCF. Just see if any questions have come through. Yeah, so one that's come through by email is, how do you handle redemption risk? I notice my other investment managers sell companies in order to pay out redemptions. So we're a company, so we don't have redemption risk, and that's a crucial part of our strategy, because we do invest very much for the long term. It's important that we can be investing and not be thinking about, well, what happens if someone redeems and we have to pay the money back in a month's time. But yeah, it's permanent capital, so we really do have a 5 or 10 year horizon for our investment, and there's a secondary market for our shares where you can find buyers for them. But in terms of our investments, we can invest with the confidence and comfort that that money isn't going to be redeemed at any time. So another question is about the dividend and policy, and our franking policy as well. So our general dividend policy is to pay out a proportion of our realized returns. So any companies that we've sold at a profit, and also pass through all the dividends that we receive from our investee companies. So we paid 2 cents in the first half, and we would look to be paying a pretty consistent dividend and gradually growing that over time. And in terms of the franking side of things, we didn't pay a franked dividend in the first half, and that's because we're just a new company and we don't have any franking credits, but we intend to pay the dividends franked to the maximum extent possible, and we expect to be paying tax as we realize profits like we have before. So we would hope for them to be fully franked dividends over time, and decent returns from dividends, but still a focus on capital return. Another question is, if a company that HCF owns shares in raises capital at a discount, will you always take up more shares and average down to hold your position to avoid dilution? So thanks for the question. Not strictly. We really invest each time. We're not really thinking about how much do we own of a company as an end goal. It's important to have influence and we want to be able to have a say, but the main thing really at any given time is how much capital do we want to invest in the company, and based on how much the returns, the risk adjusted returns we think we can get from that company. So if we are pretty fully invested in that and we don't see that we want to have any more at the current price or the price that's being offered, we wouldn't just buy for the sake of holding our holding the same position in that company. So it really depends on each scenario. I have another question, which is, do you have a view on the M&A in the space? I mentioned PropTech as an example. So I do, and I think that there's likely going to be continued M&A. I mean, you can never predict the future, but I could probably just really talk about what the present state is. And I mentioned that there's just so much value in these microcaps, and there's not a lot of institutional money going into buying shares in that and holding it passively, but there's still a lot of money floating around the system and a lot in private equity and even trade buyers. So we're seeing more and more purchases of sub 1 or 200 million market cap companies. Almost every few months there's one, or maybe even every few weeks. So I can't see what would stop that from happening other than the market getting back to a level where the value is reflected in the share prices. So we do see that continued opportunity, and we said when we IPO'd in October, and we still have the same view, that our goal is to put this money to work and get there before private equity does to buy out these companies, because we feel like there's a lot of value there. Now, I also had a question about concentration, and it's, what's your approach to concentration, and do you have a maximum for holdings? So yeah, we are a high conviction fund, of course, as the name suggests, and we like to be concentrated. We believe that the best way is to know everything about a company and be confident and buy, double down if the share price halves. So we're not afraid to have significant portions, up to 15% or more in a company. A lot of the time we would be investing, say, 5%, and through profit we get towards 15% through the share price going up. So we do have targets that we don't invest more than 15% into anything at cost. That's a kind of an internal target and mandate, but we don't have a set maximum, and we don't have concentration specific risks. There's a question about, do we have metrics on the existing portfolio valuation, and how cheap is the current portfolio compared to historic? And I might just go forward a few slides to show that. This again this is all on the ASX, so you can peruse it any time. But this is our portfolio as it looks at the 31st of March. So you can see here we have 17 companies, so concentrated. The mean forward enterprise value to free cash flow, which is when we're looking at businesses, we're looking at free cash flow, at least for the ones that they're in our cash flow generator asset play. It's currently 7 times, so we think that's pretty low. That's essentially a proxy for PE ratio, but it's true cash coming into the business. So again, that's pretty low as historically stands. We also track the mean price to asset value, and again, that's our estimate of what we believe the inherent value of these companies are, and that's about 0.67 times. So again, there's a lot of latent value in our companies, and from the way we have target prices, and I mentioned that in an earlier slide, we believe there's 76% upside for our portfolio to actually for the companies to reach their inherent value. Another question is, how do you affect change in your companies, and are you an activist fund? I definitely wouldn't describe us as an activist fund. We don't like to go and pick fights. We don't just buy large amounts of companies and spill the board, and it's very time consuming. It's not for us. But we are definitely active managers and actively involved in our companies, and we have a relatively small amount, so we can be, and it does involve joining boards where necessary, when we're aligned with the other shareholders for change, and that needs to be done by sitting on the board. We also do it from the side, working very closely with the other shareholders to convince the board to make certain changes. But again, the most important thing for these microcaps is, and any company really, you need to know that 51% or more of a company, of the shareholders, want change or want something to happen, and then we're definitely happy to be the people that enact that, or a strong voice for that. But again, we're not picking fights and risking trying to find all these proxies everywhere if we only have 5 or 10% and we don't know the other shareholders necessarily want change. But yeah, we're very actively involved, and we know the CEO as well. They should be on speed dial. We know the board and the shareholders of our investee companies very well, and have a clear view on what's being done to unlock value. So I'll just wait 1 more minute for any further questions. Otherwise, nothing coming through. I might leave it at that. And again, just thank you very much for listening in, and for your support if you're a shareholder, or your interest if you're new to the story. And please get in touch anytime. Thank you.